Welcome to our channel. Today, we're delving into a topic that may seem paradoxical, but holds significant value: the surprising benefits of failing at investing. Although failure is often perceived as a setback, it can actually be a powerful driver for personal growth and financial success. Whether you're a new investor or a seasoned trader, understanding how to transform setbacks into opportunities can enhance your overall investment strategy. Before we dive in, don't forget to hit that like button, subscribe, and tap the notification bell so you don't miss out on future videos and managing your finances like a pro. If you've got any questions or suggestions, feel free to drop them in the comments below. I always appreciate your feedback. Let's explore how experiencing failure can lead to unexpected advantages and provide you with valuable lessons. One of the greatest benefits of failing at investing is the opportunity to learn from your mistakes. Investment education encompasses a wide range of concepts including market analysis, investment principles, economic trends, and financial theories. Each failed investment provides insights into key areas such as risk management, asset allocation, portfolio diversification, investment strategies, and financial planning. Analyzing failures helps you understand market dynamics, asset valuation, investment performance, and sector analysis. It also emphasizes the importance of due diligence, research methods, financial forecasting, and quantitative analysis. By dissecting what went wrong, whether due to poor research, incorrect timing, market conditions, or financial misjudgments, you gain a deeper understanding of fundamental analysis, technical analysis, and market behavior. This process of learning from your failures contributes to improved investment planning, enhanced financial literacy, and a more sophisticated investment approach. Embracing these lessons as part of your investment education strengthens your ability to make informed decisions and develop a robust investment strategy. Investing can be an emotional journey with significant ups and downs. Facing failure is crucial for developing emotional resilience and learning to manage investment stress, fear of loss, market anxiety, and financial uncertainty. When your investments don't perform as expected, it's essential to stay composed and avoid letting emotions drive your decisions. Building emotional resilience helps you navigate market volatility, economic downturns, and short-term market fluctuations with a clear, rational mindset. This ability to manage investment-related stress is key for maintaining a long-term perspective and avoiding impulsive actions based on temporary setbacks. Resilience also enhances your capacity to adapt to market changes, financial disruptions, and economic shifts, ultimately contributing to a more stable investment journey. Failure often necessitates a thorough reevaluation and refinement of your investment strategy. When investments underperform, it's an opportunity to assess your portfolio management, asset allocation, and investment diversification. This may involve adjusting your investment approach, exploring new investment vehicles, or incorporating different financial instruments into your portfolio. Refining your strategy includes rethinking your risk tolerance, adjusting your financial goals, and implementing new asset management techniques. By learning from failed investments, you can enhance your portfolio diversification, explore alternative investment options, and improve your strategic asset allocation. This process of adaptation ensures that your investment strategy remains aligned with your financial objectives and responds effectively to market trends and economic conditions. Experiencing failure provides a unique opportunity to gain market insight and better understand economic indicators, market trends, and sector performance. Analyzing the reasons behind unsuccessful investments helps you become more adept at interpreting market signals, economic data, and financial reports. Understanding market cycles, investment patterns, and economic forecasts can significantly improve your ability to anticipate future trends and make informed decisions. This enhanced market insight allows you to identify promising investment opportunities, recognize potential financial risks, and adjust your strategy accordingly. By learning from your failures, you become more proficient at navigating complex market environments and leveraging financial analysis for strategic advantage. Failure highlights the importance of effective risk management. When investments don't meet expectations, it underscores the need for better risk assessment, risk mitigation, and financial controls. Strengthening your risk management strategies involves understanding volatility, liquidity, market risk, and credit risk. By analyzing your failed investments, you can develop more robust risk management practices, including hedging techniques, stop-loss orders, and diversification strategies. This approach helps you manage potential losses, protect your capital, and maintain a balanced portfolio. Enhanced risk management ensures that you are better prepared to handle future uncertainties and safeguard your financial interests. Failing at investing can improve your decision-making skills by teaching you to evaluate investment opportunities more critically. Each setback provides insights into decision-making processes, analytical techniques, and strategic thinking. By learning from your mistakes, you become better equipped to assess financial options, evaluate risk versus reward, and make more informed choices. This enhanced decision-making ability helps you develop a more disciplined approach to investing, including better due diligence, financial analysis, and strategic planning. It also improves your capability to set realistic investment goals, monitor performance metrics, and adjust your strategies based on evolving market conditions. Failure can also provide an opportunity to build and strengthen your investment network. Engaging with other investors, financial advisors, and industry experts can offer new perspectives and insights. By discussing your experiences and learning from others, you can gain valuable advice on investment strategies, market analysis, and financial planning. Networking with professionals and peers helps you stay updated on industry trends, regulatory changes, and financial innovations. This expanded network can provide support, resources, and opportunities for collaboration, ultimately enhancing your investment approach and knowledge. Finally, experiencing failure in investing fosters personal growth and encourages a growth mindset. Embracing challenges and setbacks as learning experiences helps you develop resilience, adaptability, and perseverance. This mindset shift is crucial for overcoming obstacles and achieving long-term success in investing. By viewing failure as a valuable part of your investment journey, you cultivate a positive attitude towards learning and improvement. This perspective not only enhances your investment skills, but also contributes to overall personal and professional development. In summary, failing at investing can offer numerous surprising benefits, from enhancing your investment education and developing emotional resilience to refining your investment strategy and gaining valuable market insight. Setbacks provide essential opportunities for growth and improvement. By embracing failure as a learning tool, you can strengthen your risk management, improve your decision-making skills, and build a robust investment network. Additionally, fostering a growth mindset helps you turn challenges into stepping stones for success. Thank you for watching. If you found this video insightful, please like, share, and subscribe for more content on investing and financial strategies. Don't forget to leave your comments and experiences with investing failures and how you've turned them into opportunities for growth. Stay tuned for more valuable tips and insights.